market movers. This is The Pulse.
Wednesday morning, welcome to The Pulse. I'm Guy Johnson. I'm in Zurich today. We've got a lot going on. UBS signaling a bigger buyback as traders help smash estimates. But Chief Executive Sergio Ermotti warning us that investors may be a little overconfident about what's happening with the Middle East conflict. The US signaling it will stick with a naval blockade of Iranian ports to try and force Tehran back to the negotiating table. Plus, investors on edge, of course. It is a bumper day of earnings from the US tech giants. We've also got a Fed rate decision coming up a little bit later on. How is all of this being priced into the markets? Let's take a quick look at what we are seeing. Equity markets broadly are fairly flat on this side of the Atlantic. Over in the United States, ahead of the big tech reports we're getting later on, the Nasdaq is bid right now. We're up by around 0.3%. The US 10-year a little on offer. Look at the number at the bottom though. That is the number you want to pay attention to. We are now 113.49, up 2% on Brent. That is the big figure that we are watching out for. We're also starting to get some economic data coming through as well. We've got CPI data coming up a little bit later on out of Germany, but we get the state data. This on the back of very strong data out of Spain a little bit earlier on. Bavaria consumer prices up 0.5. We're just getting that. North Rhine-Westphalia up 2.7. That's a year-on-year number. One was a month-on-month, one was a year-on-year number, just to confuse things a little bit there. But the broad picture at the moment is oil prices are higher, tech prices are higher. Those are the two things that the market is grappling with right now. But we've got an awful lot of earnings that we need to price into these markets right now. So let's get on and talk a little bit about some of the bank numbers that we've seen coming out from across Europe this morning. We've had a series of numbers. We've had Deutsche Bank, we've had Santander, and we've had UBS. Look at UBS. We're up by 4.6% on the back of the numbers that were delivered this morning, the Q1 numbers. This after the Swiss lender posted first quarter profits. They're very much topped estimates. The bank confirmed also its intention to add to the 3 billion tally of share buybacks this year. That comes a little bit later. They're accelerating that buyback program. So I caught up with the bank's CEO first thing this morning, Sergio Ermotti. We started off talking about the company's earnings and what traders in particular have delivered.
Not only our traders, I think that all the businesses have been performing quite remarkably. I mean, if you look at all of them delivered double-digit growth, and also from a regional standpoint of view, we had outstanding results across the board, and particularly in our Asian business. Okay,
let's talk about the buyback. Last quarter, you indicated that things would improve this quarter. We were expecting an update. We were expecting a positive update. That was the signal to the market. This time round, you haven't delivered that. There's a number of different reasons behind that decision, and you've basically punted it until the next quarter, Q2. One of the reasons appears to be around the capital requirements story that is currently now starting its journey through Parliament. Are we really going to have enough clarity next quarter for you to be able to give us an update on what's happening with the buyback?
Yeah, well, actually, we are giving an update this quarter by saying that we believe we're gonna complete the 3 billion buyback by the end by Q2 results, so by the end of July, which is clearly a change compared to what we said before, which was we would do 2 billion. So I think that in that sense, what has changed is that there are 2 or 3 conditions for on how to manage capital returns. One is progress on integration, which we tick the box with the migration of the Credit Suisse clients into our Swiss platform. Number 2, the financial performance. You saw the strong results in the first quarter, and our ability to maintain a capital level at around 14%. We are at 14.7%. So I do believe that we delivered on some things. The uncertainty around the regulation is something that is going to take time.
Yes.
And is definitely will influence our capital return plans, but it's not the only conditions.
Okay. Do you expect any clarity by next quarter on that front?
Not a lot of clarity. Okay. I think that if you look at the political processes starting early next month, so in a week time, and I think that is going to take time. This is a complex matter. It took first 2 years of discussions. I think we cannot really pretend that the Parliament jumps into conclusions very quickly. So we are happy to be able to contribute.
The Parliament, you're going to contribute. Okay, we'll maybe come to that thought in just a moment. Parliament normally waters things down. Do you expect it to water this down, the foreign subsidiary 100% rule? Do you think that gets watered down by Parliament?
I honestly, I don't think I'm hopeful. I don't expect anything. I'm hopeful.
Okay.
There's a big difference between being hopeful and expecting anything.
What do you want out of it? What would be an acceptable? You're lobbying hard. What's the end point that you want to get to with this lobbying effort? What would be?
We are not lobbying hard. We are just representing, the interest of. It's our duty and right to basically highlight what are the consequences to our shareholders, to our clients, and also to the employees in Switzerland. I mean, we have 30,000 people, so we are just trying to contribute to a fact-based discussion. So,
okay.
And which it was not always the case. So what we expect, I mean, is we are not asking for anything other than having something that is internationally aligned,
okay,
and allow us to compete out of Switzerland in a fair
okay.
way. But it's also very important because the issue is that what needs to be done, the true lessons learned from the Credit Suisse crisis, really understanding the root causes of what happened is very important, because without the concessions that were granted to Credit Suisse would have not gone down in this way.
All of that, I'm sure, is correct, but the government is looking at 100% foreign subsidy and the foreign subsidiary capital requirement. You've never said what the number is you want. You've never said you want to contribute, but you've never indicated publicly what would be an acceptable outcome. We must be getting to the point,
Sergio, we are not in a negotiation. We are a receiver here. So, okay. I mean, it's not like by saying what we wanted, we're going to get what we want. So okay. I think that there are plenty of options.
But you've never said what you would take. You've never said what would be an acceptable number.
What we are trying to show is what are the international standards, what are our peers operate.
Standards? What is an acceptable international standard?
The outcome of this proposal will translate on us having 30, 40, 50%, I mean, depending on how you calculate, an extraordinary amount of excess capital that is going to be totally unproductive and won't that is not capital that you can use to give loans to serve clients and or to do acquisition, to return capital to shareholders. So it's basically dormant and unutilized capital. So we want to be able to compete while also protecting taxpayers, right?
So what's the number? So what you want to be able to compete, but you want to be able to protect taxpayers. There is somewhere in the middle there.
Guy, do you really believe that I'm going to give you a number?
No, but at some point we need to find out, don't we? The Parliament is now debating this. You're at 100% in Parliament. It's going to get watered down, maybe, but what would you take when it comes out of Parliament? But it's a political process. They need to decide based on all the facts they're going to use. So we are contributing. So we are not going to engage in putting down numbers and having a debate. So I think that we have to put down facts, and we have already a very strong regulation. When our existing regulation, when fully implemented, is strong enough, or was strong enough, for UBS to take over Credit Suisse and stabilize again within 5 months. So this is a fact. Okay. The lobbying effort, let's just talk about that. The finance minister said that your efforts are not very Swiss. That sounds like a fairly blunt attack on UBS. Your response to that?
Well, look, I think that is our right to represent, and duty to represent our interest, and I'm not going to go down and engage in this kind of...
But how would you describe relations with the government at the moment? Are they functional? Are they workable? What's communication like? Because that sounds like a fairly blunt attack on UBS.
I think our relationship is professional.
Professional. Excellent. Let's talk about kind of what happens next, therefore, in all of this. You must be reaching the point where you have to make some fairly tectonic decisions about what you do with this business. It feels like you're at the point where it's kind of go big or stay home. Go big or shrink. Is that the point we're getting to?
It's premature to speculate about timing on these things because it may or may not take. It may take months or it may take longer to resolve this matter. So we're not going to jump into the conclusions. Our top priorities is to operate successfully as a global bank out of Switzerland. We always say that, and we're going to continue to fight till the last minute to make sure this can happen.
Okay, so it is still possible that you could relocate. That is still an option.
This is a speculation, so I'm not going to comment on speculation.
You have said that shrinking is not an option.
That's a certainty.
Okay, so that's off the table. So shrinking is off the table.
But that's not a speculation, that's a certainty.
Okay, so that's a certainty. So you're not going to get smaller, so are you going to get bigger? So your chairman has talked about the fact that buying a wealth manager in the United States would be a possibility.
That's a speculation.
He said it.
But, no, he said that we will need to take measures to protect our shareholder interest. That's another matter.
He talks about buying wealth managers in America. Would an acquisition give you more?
But that kind of statement was done back and totally
so that's out of date.
Outside the context of this discussion on too big to fail. So the fact that we want to continue to grow we are the leader in wealth management.
Yep.
And the US is a very attractive market, it's the largest market in the world. And what we are trying to do is to make sure, by the way, we make more than 2 billion a year on average in the US, and we believe we can make it better and we can grow further, and it's part of who we are. So, but this comment was done a couple of years ago, totally outside this too big to fail discussions.
Nevertheless, would an acquisition in the United States give you optionality? I'm trying to figure out what your options are.
No, our options right now in the US is to execute on our current plan. We can do better with what we have, and we have plenty of room to really understand what needs to be done organically or non-organically to grow. But the center of our strategy will always be to be around wealth management. So 60% of our revenues right now is in asset gathering businesses, asset management and wealth management. Yeah. And so whatever we do is won't change who we are.
So I should not expect big decisions at this point. You're not there yet.
Absolutely right.
Okay, next 6 months I can park that. Because that's the question I get from analysts. It's kind of, you're talking to Sergio, can you find out what's happening in the next 6 months? Because we're expecting big things to happen and we think he needs to make some decisions.
Well, how can you make decisions without having all the information? And we have some critical information needed before making strategic decisions.
Sergio Ermotti, the CEO of UBS, speaking to me here in Zurich first thing this morning. As we saw those numbers being released, very well received numbers this morning. The bank is certainly delivering at the moment. You're certainly seeing the iBank in particular delivering very strongly. The shares are up really well on today. Let's talk about, it's been a busy day for banks. It's not just UBS that's out with numbers this morning. Santander's net income also beat. Deutsche is a slightly different story. Deutsche Bank posting higher than expected profit and revenue with fixed income and currencies trading a little flat for the year. Investors, though, maybe punishing the bank a little bit this morning. Santander edging a little bit higher. So we caught up with both the CFOs. So let's take a listen to what they had to say.
The FX has certainly played, the headwinds from dollar-euro or year-over-year certainly played a role. That said, first quarter last year was a record quarter for FIC. So I think matching a record performance in these conditions, I think, gives me a lot of confidence that not only have we been able to overcome the FX headwinds, but able to match a fantastic first quarter. Obviously, there's a little bit of a March impact in there that impacted the results, but all in all, I think FIC's held its own.
This is the first quarter that we are presenting after our Investor Day in February. We are on a very, very good path to meet our targets for the year. But very importantly, this is a very strong first step towards the 3-year plan. And at this point, we see no reason to change either our guidance for the end of the year or the targets for the next 3 years.
The view from Santander, the view from Deutsche Bank. Let's talk about the markets, because trading has actually had a fairly big impact on all of these numbers today, and we're seeing a certain amount of volatility emerging already in this session. So a few minutes ago, I showed you what was happening with the NASDAQ. Futures now rolling over on the NASDAQ. Oil is definitely moving higher, spiking, you could say. President Trump saying just a few moments ago that Iran can't get their act together. We are seeing a standoff. The Strait of Hormuz is still closed. Oil prices continue to climb. But at the same time, you're seeing earnings delivering and you're seeing technology stocks rocketing higher. Wolfgang Rotberg, equity strategist at Safra Sarasin, joining me here in Zurich. Good morning.
Good morning.
So you've got this tension in the market at the moment. You've got an oil price that's kind of, 113. We're moving higher this morning. We're spiking. We're pushing higher. We're at year highs now. And at the same time, you've got earnings numbers that are coming through okay, but they're slightly rearview mirror, so they're kind of reflecting what has happened, not will happen. And you've got this view that technology is going to deliver. The chip stocks in particular are going to be massive beneficiaries of AI spend. How does this tension in your mind get resolved?
Well, if we look at the market itself, what's worked quite well over the past 2 months is the correlation between the PE and the oil price. So basically inversely correlated, with the PE benefiting when the oil price falls. Over the past 1.5 weeks or so, there's been a bit of a decoupling. Say basically the PE is now priced for an oil price of 90. Oil price is obviously back above 100. So say the market is really trying to move on from the conflict.
Yeah. Is that the right thing to do?
I think it's the right thing to do, in a sense that I would say, there's a window for a solution, for a resolution of the conflict. I think the two parties are moving towards one another in a sense that they, put options on the table. And say if the stress increases to a point at which, in particular, Trump would say, okay, this is unbearable, this is now really hurting him, he may turn around and try to strike a deal.
So we're still relying on the Sacco trade?
In a way we do, in a way we do. But I think until, let's say, 2-3 weeks ago, the situation was slightly different in a sense that really you couldn't see how the whole thing plays out at the end of the day, because the Iranians didn't even come to the table, let's say, to negotiate. Now they've shown some willingness at least to open the Strait of Hormuz because they feel the pain themselves, which I think, is creating an incentive on both ends to find a deal at the end of the day. If this will happen in the very near term, difficult to say. But I think there's a cap, let's say, in terms of how high the oil price will go at the end of the day and how low the market could potentially go.
What's the upper cap?
The upper cap for the oil price is probably somewhere at around 150 max, but this is not our base case. But I would think at this point we will really see oil starting to hurt the consumer in the US, which has not happened so far.
That hasn't happened yet. We're starting to see it showing up in Europe, though. I see the PMI data. It started to roll over. Spanish CPI this morning, higher. We're going to get German CPI very shortly. The ECB is potentially talking about hikes. Are we back to American exceptionalism when it comes to equity markets? Do I want to put money to work in Europe? Do I just put money to work in the United States?
If I look at the data, definitely, we are back at US exceptionalism as compared to Europe. Most recent economic data, as you mentioned, PMI is weaker in Europe. We also had the bank lending survey coming out of the ECB, quarterly bank lending survey coming out yesterday. Conditions deteriorating to the worst since the end of 23. And this is a great lead indicator for PMIs, which suggests that PMIs actually go below 50 over the coming months, after the drop which we have seen now in March or in April in the flash numbers. And this is not pointing at an environment in which Europe can thrive. On top of that, and I think the transmission channel through the central bank is, let's say, more difficult in Europe than it is in the US. Obviously, US Fed has a double mandate. They say basically, look, we look at inflation, but we also look at the cycle, or the labor market in particular. While in Europe, it's very clear focus on inflation. Meaning, if we were to see a kind of further spike in inflation, the ECB may react more aggressively to that, and I think the market is priced for that as well. In terms of if we look at the rates market pricing, obviously 2 hikes from the ECB, no hikes from the Fed.
Is it American exceptionalism? Therefore, do I just buy America, or do I just buy big tech? It's slightly more geographically sort of uncertain where I buy big tech, because you can buy it in Asia as well. Obviously, there's a lot of chip stocks out there. Or in the United States. But am I just buying tech to hide from the geopolitics? Is that the narrative?
Kind of. But I think what's happened also is that the tech trade has broadened, in particular in the US. Look at industrials, look at utilities. all of these sectors have somehow become part of the tech supply chain. And as such, benefit from the massive spending which we are seeing in the coming from the hyperscalers, something which we expect to continue. And meaning, it's more than just tech in the US. In Asia, I would be more selective. It's just tech in a sense that it's basically the
exposed to the energy market in Asia more so. So maybe much more selective.
Exactly. But if we listen to what the semi names in Asia are saying, in terms of like shortages on helium and so forth, where there was some concern just a couple of weeks ago, they seem to be fine. They've kind of rejigged their supply chains, getting more out of the US, have some storage capacity still, or have some helium in storage, that they won't suffer for another 2 months or so, before basically helium starts to become more critical.
Okay, last question. We're often looking at the downside because we're worried about what's happening with the geopolitics. But is there a risk of are you hearing talk of people about a melt-up? That basically you get markets pushing to extreme levels. Does it feel extreme at this point?
It doesn't feel extreme if we look at the valuations. We're back at 21 times in the US. PE at the peak we were closer to 23 times. So we've definitely derated. In particular, if you look at semis, if you look at software, some of the sectors which were more highly valued, valuations look quite reasonable now. So it doesn't feel extreme, but I wouldn't expect a massive melt up unless we see a resolution, really, kind of a proper deal in Iran. And then you could really see the market pushing higher because the biggest roadblock is just being removed. But for the time being, fundamentals strong, geopolitical risks lingering, kind of an environment in which the market can grind higher if earnings come through as they are expected, but not a major melt-up from where we are right now.
Wolf, thanks very much indeed for stopping by to see us here in Zurich. Always appreciate it. Thank you very much indeed. Wolf von Rotberg, equity strategist at Safra, Sarasin. Thank you very much indeed. What are we going to talk about next? Airbus says it's confident it can achieve its full-year aircraft delivery targets, despite last night delivering a steep earnings drop. Benny Camel, who leads our aviation coverage, are going to join us next with the details. That's next. This is Bloomberg. 23 minutes past the hour. Let's talk about one of my favourite subjects, aeroplanes. Airbus says it's confident it can achieve its full-year aircraft delivery and earnings targets. This despite a steep drop in earnings that was delivered last night. These are Q1 earnings. The persistent engine shortages continue to be an issue. They make money when they hand aircraft over. You can't hand aircraft over unless you've got an engine on them. Anyway, let's talk about this with our managing editor for aviation, Benedict Camel. Benny, the engine problem persists. Can they fix it for the rest of the year?
Well, rather confident Guillaume Faury seems to think so, but if you look at the numbers, there's a lot of hope built into that. They're still sticking to their prediction for the year, thinking they can hand over 870 aircraft. But if you look at just the first 3 months, just a few more than 100 that they handed over. So there's a big delta there between what they did in the first quarter and what's remaining. But again, they said, as usual, it will be backloaded, that sort of parlance from Airbus, that we'll have most of our production crammed into the last couple of weeks of the year. And they think that they can get some kind of an agreement with Pratt & Whitney to hand over more of the engines. Pratt & Whitney being the main culprit here on the A320. That's where they're missing the engines. So if they can get that resolved, they should get to or close to their target. The upside is the demand is there. Customers aren't deferring orders. That was one of the key questions that Guillaume Faury was asked. Are customers wavering? Is anyone nervous about what's going on in the Middle East? The answer is no. Everyone wants the aircraft. Everyone's actually wanting them more than ever because they are fuel efficient, and we all know what's happening with fuel. So that demand picture is there, but it's just that Airbus is having trouble making the planes, and that's holding them back.
So let's talk about momentum, which is important when it comes to aeroplanes. Airbus is struggling for momentum, but Boeing appears to be regaining its momentum. Is this a fair comparison? Is it because the starting positions over the last 18 months, 2-3 years appear to be very different?
Yeah, absolutely right. I mean, if you look at the Boeing earnings a week ago, really no nasty surprises there, which is something we'd sort of gotten used to over the years. There was always something tucked in there that was quite horrible. In this case, a very steady Boeing doing what they do best, which is making aircraft and making them at a faster clip. They are increasing output of their 737. And Airbus, you know, again, no nasty surprises, but again, no forward momentum here. They are being held back. And that's really what they need to watch, that you have a Boeing that is coming back, that is stronger, that has Donald Trump, the US president, as their sort of chief salesman. He's going to China in a couple of weeks, so we should expect some deals there. So that's where things are going.
Benedict Campbell from Berlin, thank you very much indeed. Up next, we're going to talk about Mr. Trump. We're going to talk about no more Mr. Nice Guy. Diplomatic resolution? Maybe not. More next. This is Bloomberg. Morning, welcome back. Watching the Pulse, I'm Guy Johnson from Zurich today, and these are the top stories you need to know about. UBS pledging a bigger buyback as traders help smash estimates, but Chief Executive Sergio Ermotti warning us that investors may be a little overconfident about the outcome in the Middle East. Oil spiking as President Trump says Iran can't get its act together and doesn't know how to sign a non-nuclear deal. Plus, investors on edge for a bumper day of earnings from the United States. We've got tech giants on deck. Plus, we've also, of course, got a Fed rate decision. OK, let's talk a little bit about what is happening in terms of the corporate numbers that we are seeing this morning. UBS is having a very strong day. We're up by 4.36%. This after the Swiss lender posted first quarter profits that topped estimates. I spoke to the company's CEO, who, of course, is Sergio Ermotti, about what he saw in these earnings. He also gave quite an interesting outlook and maybe a bit of a warning, you could argue, to investors when it comes to the Middle East conflict.
The recent developments in the Middle East are now putting a new major uncertainties on the table, with supply chain disruption on energy and driving inflation higher. The expectations is not only that things are going to be resolved, which we believe and hope is they're going to be resolved, but the impact of what happened will be resolved in a classical way we saw in the last 10 years, V-shaped. Everything is going to go back into normality.
Meanwhile, the US President, Donald Trump, posting over the last few minutes on social media, warning that Iran can't get its act together, and warning basically about the lack of opportunities to get a deal done. Oil is definitely moving higher on the back of these comments that we've been seeing. So let's get a kind of in-the-minute update from what we know, what we don't know, from Jumana Basekci, who joins us now from Dubai. Jumana, we've had a load of comments over the last few hours, plus we've also had these comments out of the Wall Street, this story out of the Wall Street Journal as well. Talk us through what we know this morning and what's moving oil prices higher.
Yeah, that's right. Well, just in the last 15 minutes or so, we got this Truth Social post from Trump suggesting he is not going to be Mr. Nice Guy anymore. He's saying Iran can't get their act together. They don't know how to sign a non-nuclear deal. He probably means a nuclear deal in this respect. And of course, the background to all of this is we know that after a whirlwind trip over the weekend, the Iranian foreign minister, meeting with many mediators, presented a proposal to the US to work towards ending the war, but via a two-phased approach. The first part of it would be the mutual lifting of the blockade around the Strait of Hormuz, and then deferring the discussions around the nuclear file to later. Now, the last couple of days, we have been waiting for an official response out of the White House. We haven't actually got an official one. But to your point, Wall Street Journal reporting this morning that President Trump has sat with his advisors, has assessed the multiple options that he has, including walking away, a resumption of hostilities, or indeed an extension of the U.S. naval blockade. And Wall Street Journal reporting that he's opting to continue the blockade because in his eyes, it is actually working. Because the longer this blockade goes on for, as we know, the more it's going to restrict Iran's ability to export oil. Storage capacity is filling up, and at some point, this will bring the Iranian regime back to the table. Now, that is the thinking from the U.S. perspective. And indeed, yesterday, President Trump described the Iranian regime as being very fragmented and on its knees. Now, the question is from here whether that is is actually the case, whether the Iranian side will be incentivized to return back to another round of negotiations in the absence of the U.S. lifting their blockade, or whether we're in a situation of a standoff where both sides are waiting for the other side to blink. And the real possibility here, especially with this latest Truth Social post, of another round of hostilities, which cannot be removed as a possibility right now.
So the UAE has decided to walk away from OPEC. You've been getting the Emirati reaction, or kind of the thinking behind this decision. But what's the wider reaction in the region to this decision?
Yeah, well, Guy, you know, it's interesting because the announcement itself was pretty shocking, but nobody's really surprised. The background to all of this is there had been simmering friction between the UAE and the Kingdom of Saudi Arabia, the de facto head of OPEC, for years. And that, you know, it all came to a head back in 2021. And at the crux of this is, you know, one, economic incentive, and the other is geopolitical. But on the economic side of things, the UAE has been pushing for extra production, and they've been pushing for extra capacity over the course of the last few years. Out of all OPEC members, they are the ones that have increased the capacity by the most. Before the war, they were pumping around 3.6 million barrels a day. They want that figure to get to 5 million by the end of 2027. But of course, were constrained by the collective decision-making by virtue of being part of OPEC. Now, when I spoke to the UAE energy minister yesterday, and this is right after the announcement, what he did say is a careful decision was taken, and right now will not hugely impact the market, as the market is clearly undersupplied. And I think here, if you look at the reaction in oil markets this morning, this actually vindicates the UAE decision to leave OPEC. If they had come out with this decision maybe a year ago when we were talking about the market being oversupplied, you would have seen the knee-jerk reaction of oil plunging the next day to account for perhaps a market share war in the market or an increase in production. Today is a very different environment. We're talking about 10 to 12 million barrels a day of the region taken away from the market. They knew that this was a window of opportunity for them to make this announcement and perhaps work towards increasing to their maximum capacity. And just one final thing on the geopolitical point. You know, as we've been reporting over the last couple of months, there is a growing rift between the UAE and Saudi Arabia in terms of their deferring approach to Iran and various regional conflicts as well, including in Yemen and Sudan. And it's all just come to the fore now with this latest decision.
Jumana, thank you for the updates. Jumana Basechi joining us out of Dubai with the latest. Let's come at this from a different angle. The Shell CEO says oil and LNG shortages caused by the blockade of the Strait are likely to drag on for months and possibly into next year. Well, Sohan telling us he foresees ongoing tightness in the energy market.
We're talking about 900 million barrels that have not been produced in the last couple of months, and that's been replaced by essentially stock drawdown. We're now sort of starting to reach some relatively low levels. We're talking about demand curtailment in certain areas. We're talking about fuel switching. So this is profound. And not just for oil, by the way. It also plays in, of course, for LNG. 20% of the global LNG production comes from the Middle East. And all this is happening with the backdrop of sustained growth in energy demand, of which, to your point, Ed, some of it is being, of course, contributed to by the growth in AI and technology demands. And so it is indeed a tight situation. And this is why it's incumbent upon us, the energy sector, to continue to invest in all forms of energy, to make sure that we are able to provide that energy to support multiple countries as they're looking to both grow in their own consumption of energy, but also those that are looking to underpin their AI and technology journeys ahead.
Well, El Sohan, the CEO of Shell, speaking to us a little bit earlier on. Let's try and pull it all together and get a handle on what is happening here. Gorana Grgić joins us now to talk about what is happening. The head of the global security team at ETH, the Zurich Center for Security Studies. Good morning.
Thank you for having me.
I don't know where to begin because things seem to be moving quite quickly, but let's start with the idea that we have an extended blockade of the Strait of Hormuz. Is that the base case now? That we are in a kind of phony war, that nothing is happening and nothing is moving, but we still remain with a strait that is closed?
Well, that would be a sort of middle option, if you wish, between President Trump waking up one day and deciding this is all over and he's going to sort of step back and withdraw, or the alternative, which would be the other end of the scale, which would be a full escalation and resumption of a large-scale violence that we've seen in the first days of March. Look, at the moment, this is something that looks like a stalemate that is increasingly hurting both sides. Of course, for the United States, it's something that contributes to the affordability crisis, that's depleting munitions, that's depleting the attention and the resourcing that's now dedicated to the Middle East, when there are other things that the U.S. grand strategically could be doing. But of course, it's hurting Iran as well. And now it's a question of who is going to budge first and what is it that they are going to agree on to get them to the table.
If you look at the bell curve, you look at the distribution of outcomes, so stalemate is in the middle.
Sort of.
Kind of, sort of, maybe somewhere in the middle. But how close are those two other tails to them? Like how big are those tail risks? How likely could they kind of shift to the right or shift to the left?
Well, I would say we've been observing President Trump in this role for the past, 10 years now, nearly, right? With a little bit of a break. And the thing with Donald Trump is that we simply don't know, right? This is the thing which allies need to plan with, that rivals also seem to be testing, that they have to take into consideration in their calculus, because as we've heard now, he's saying he's no longer going to be a nice guy. A couple of days ago, there was still talk of Islamabad talks. He was threatening with civilizational erasure just before that. So just that sort of risks that are associated with this sort of highly personalized decision making are extremely high on both ends, right? It could be a sort of step back, and it could be the famous taco, right, that Trump will chicken out in the end, but it could well be something that, you know, is more on the belligerent side, and notwithstanding the fact that we have a huge deployment of U.S. military resources in the Gulf that we didn't have necessarily just a couple of weeks ago, right? And those options are still on the table, and while they are not being now the front and center of some of the media discussions, they have been on the table just as well, right? Special ops and similar other things, seizing of Harg Island and all the rest.
So I remember studying IR, and I remember game theory, and there's all kinds of kind of sort of diplomatic theories,
signaling,
all kinds, like loads of things that you get taught. None of that is being applied right now. So what are we watching? Like how do you kind of view this? How do you compartmentalize? Put it in a what is it that's happening here in terms of diplomacy or lack of diplomacy, or what is it?
So I think that the adjective unconventional has lost all the meaning, right? We are far from that. We are far from, you know, just that point where we were tearing up all of those IR kind of 101 books. Where we are is basically trying to read the tea leaves of what some of the closest advisors to the presidents might be saying. Who is that last person that he's talked to? Again, ultimately, he is the decider in chief. Some of the things that he is reactive to or has been is how the stock market is faring. We know that he doesn't like the bad news there, but what might sway him to maybe lessen the tensions is the fact that with every day we get closer to the midterms. Of course, that's happening in November. So the longer, again, that this goes on, he doesn't want this necessarily war to be still on top of the news agenda. So those are the things we should be eyeing out for, right? Rather than these sort of theories of interagency process conducting kind of, we are
none of that works anymore. Let's look at this from the Iranian point of view. What is your assessment of how fragmented the Iranian regime is? There is this concern that oil tanks are filling up, and as a result of which they're effectively going to have to cap wells, which may not be able to be reopened, so they don't want to do that. What is the driving motivations, do you think?
As it has always been from day one, it's regime survival. And if anything, for Iranian regime, this has made it just more hardline. Regardless of what's going on in the country and what is going on, what we can hear, at least from media report, is a shortage, of course, of food now, huge inflation rates, right? Things that are happening in terms of, you know, some of the damage to the infrastructure that are going to take decades to fix. But at the same time, this is not a game of what the populace at the moment will be doing or saying, because it's time of war, and it gives still the upper hand to the regime in Tehran. On the fragmentation question, I would defer to anyone who is more of an Iranian politics specialist, but at this point in time, I would say that the incentive would be again to hold together at the moment, right, and kind of try to coast through this crisis rather than to try to sow division, because they know that this is, again, the lack of cohesion is something that could lead ultimately to the demise.
Great to see you. Thanks for stopping by us, updating us on what we should be watching out for. Gorana Grgić joining us from the Centre for Strategic Studies at ETH Zurich. What have we got coming up for you? We're going to move from the geopolitics back to the markets, back to the tech story for the Magnificent Seven report later today in a key test of whether or not the AI investments story is paying off. More on that next. This is Bloomberg. Seven minutes past the hour. Welcome back. You're watching The Pulse. I'm Guy Johnson in Zurich. Now, ahead of the full German CPI reading this afternoon, fresh data from the country's state suggests that the April print may not be as strong as feared. The uncertainty around the economic impact of the energy shock is likely to see the ECB, though, maybe leave rates unchanged tomorrow. But we're waiting for more information. That said, we did see quite a hot Spanish number a little bit earlier on. Maybe that is a factor that we need to put into the thinking as well. Zoe Schneeweiss, Bloomberg's economics editor, joins us now. Mixed data, Zoe, so far this morning. We're going to get the German data a little bit later on. The hot number out of Spain is worth paying attention to. But this data feels, and I put it with the PMI data, this data feels more and more stagflationary with every number that I see.
Yes, that's right. Even though the German numbers later this afternoon, might not be as strong as some had feared, anything close to 3 obviously is very bad news. That combined with those GDP numbers, and we will get GDP readings across the region for the first quarter tomorrow, just does point to that stagflation picture. Again, the first quarter, the numbers might not be as bad yet as what we will see in the second. The first quarter, we had 2 months of that first quarter before the war started, but still 1 month just will mean that growth won't be as strong as it might have been otherwise, and that stagflation picture is very bad news for the ECB.
Yeah, it makes you wonder what exactly it will do. There is a danger in hiking, and there is a danger in cutting, and there's a danger in doing nothing. So what are we going to get tomorrow? And more importantly, what do you think we're going to get in June?
So tomorrow, it's unanimous from all economists we've surveyed, it'll be a hold. The reason behind this is they just don't have enough hard data yet. And the numbers we have, those PMI numbers, those other survey numbers, people, as Philip Lane, the chief economist of the ECB, pointed out, those numbers, those data all are based on people reading the same reports we are, where there's just uncertainty there. So they are in a way guessing as much as we are. We need some more hard data. So tomorrow's too early. June is very much on the table. And economists and markets here both do agree that they think there'll be a hike in June. Lagarde herself tomorrow, let's see what she says. She generally has tried to be very careful here. They have that whole line with a meeting by approach. They don't want to preempt anything. They don't want to tie their hands. Because if you remember back in 2022, one of the reasons why they started late was because back then they still had forward guidance. And forward guidance was then blamed for not starting to hike as soon as they maybe should have, although the ECB is trying to explain that back then waiting maybe a few months longer than they should have on hikes didn't actually change the overall picture. But still, the ECB is keen to avoid mistakes, and therefore giving hints but not being that concrete is their way forward on this.
So a must-watch press conference coming up tomorrow, and we look forward to the coverage from you and the rest of the team. Zoe Schneeweiss joining us ahead of the ECB. Traders are also, of course, trading cautiously ahead of today's rate decision from the Fed. Jay Powell's final meeting before his term as chair expires. So let's talk about what we can expect here. Bloomberg's Jill Desis joins us on this. So You got a whole sort of question around what happens with interest rates, but to be honest, that's the boring bits. What's happening with the economy, I think, is a more exciting conversation. What is a really exciting conversation is what is Jay Powell going to do next? Is he going to stay or is he going to go? Because if he steps down as chair, he doesn't have to lead the board. So what's the story there, Jill?
Yeah, Guy, I mean, that's really the only question here. I think it's, pretty widely expected. Fed's just in wait-and-see mode when it comes to rates. So when it comes to Powell, I mean, that's the one where we want to see whether or not he ultimately stays on. Look, at this point, the vote for Kevin Warsh looks like it's pretty poised to go forward. Powell's term expires on May 15th. It's the middle of the month, so we're probably looking at Powell's last meeting here as chair. Now, his term, though, doesn't expire for the next couple of years. So that's really the question here as to whether or not this is an environment that he continues to stick around in. He's certainly indicated that until that federal probe into the Federal Reserve ultimately is resolved and done and dusted, that maybe he's not really going anywhere. But I think it's going to be really interesting to see how he takes this press conference and ultimately addresses ongoing pressures that Donald Trump certainly has from him. We've also seen in the form of Kevin Warsh talking about the idea of regime change at the Fed. Is that an environment that Powell can continue to operate in if he's no longer a Fed chair? I think that's ultimately what we're really looking to see out of his last briefing today.
It's going to be, again, must-watch television. So are we all good to go on the Warsh nomination? Tom Tillis is behind it. Nothing standing in his way now.
That does seem to be it. I mean, you've got broad consensus from the rest of those GOP senators that they're willing to move forward this nomination. It was really Tom Tillis that was standing in the way here. He seems to be satisfied with the responses that he's gotten from the administration on that probe into the Federal Reserve. So at this point, we're looking today at a likely advancement out of this Senate committee. Then they still have to sort of schedule that full Senate vote. But at this point, there doesn't really seem to be any further obstacles. So assuming that there's no sort of like last minute surprises or anything like that, we're probably looking at somebody that's ultimately confirmed before Powell leaves on the 15th.
Jill, great stuff. Thank you very much indeed. Jill Deese is joining us ahead of the Fed meeting a little bit later on. And we're not done yet. So we've also got to deal with big tech. Microsoft, Amazon, Meta and Alphabet all reporting after the market closed today. Apple, of course, comes tomorrow. Matt Bloxham is here from Bloomberg Intelligence to update us. There's a lot about to happen. Which bits do I need to pay attention to? What are the key things that I should be looking out for?
Yeah, so obviously this is a big quarter. The four companies reporting tonight, between them, are planning to spend $650 billion of capex this year. That's up about 70% year on year. So a huge amount of focus on whether those investments are starting to show incremental traction on revenue. And certainly across the board, consensus is generally looking for at least a modest uptick in revenue growth in this quarter. I think the focus of that revenue growth is really going to be around particularly what's happening in cloud demand, which is largely being fueled by AI. I think there's also some kind of questions here about margin, though, too, particularly with Meta. We heard last week that there are plans afoot for them to cut about 10% of their workforce in May and also not backfill another 6,000 roles. That'd be another 7 or 8%. So quite a significant effort there from Meta to actually demonstrate that they're looking to cut overheads to help fund investment for AI. So kind of real big focus on, are they getting a return on investment?
Matt, earlier on this week, we saw a little bit of wobble in the tech sector. There were concerns around whether or not OpenAI was going to be able to deliver on its numbers. The company's pushed back on that. Do you think that pushback sticks? Do you think the market believes that OpenAI, it's all good, that there's nothing to worry about?
I don't think so. I mean, obviously, we've heard publicly from both OpenAI and Anthropic recently about what their revenue momentum is, and there's been quite a big switch over there. So Anthropic now saying it's doing about $30 billion of annualized revenue, and OpenAI maybe about kind of 24, 25 billion. It was the other way around not so long ago. So, clearly the momentum is with Anthropic right now. For sure, I think OpenAI had some very ambitious targets. For example, example, getting to 1 billion active users on their platform by the end of last year. That's not quite happened yet. It's an early stage company still, so you would expect there to be some kind of juggling once they kind of figure out what the right momentum is. Clearly, it's growing at a rapid pace, but they've also, investing big. They were exposed to some kind of long-term supply contracts, so they do need to keep growing the business very rapidly, and there's a lot of competition out there.
Matt, great to catch up. Looking forward to the coverage later on as well. Bloomberg Intelligence analyst Matt Bloxham joining us ahead of Big Tech's Big Day. OK, just a few updates on what's coming later. We're going to speak to Andy Burnham, the Mayor of Greater Manchester in the UK. That's from the Bloomberg City Lab event in Madrid. A lot of politics around Andy Burnham right now. The future of Keir Starmer very much in doubt. US futures look a little like this right now. Oil price is certainly on the move, which is a factor that you want to pay attention to. So oil prices have moved up kind of 113 on Brent as we see ongoing expectations that we are going to see the Strait of Hormuz being closed. US equity markets aren't pricing in much at the moment. To be honest, with such an amount of news flow coming later on today into the form of big tech, plus also in the form of the Fed, you can understand why maybe traders are sitting on their hands right now and waiting for an update on what is going to happen. But at the moment, you've got oil up, but you've also got tech up a little bit, 0.3% on the Nasdaq. Anyway, from Zurich, hope you enjoyed the show. This was The Pulse. This is Bloomberg.